China's gold-backed currency ambition, a seismic shift in global finance. In a move that could redefine the global financial system, China has been quietly but aggressively pursuing a strategy to relink its currency, the yuan, to gold. This audacious plan, unfolding over recent years, is not merely a financial maneuver but a geopolitical chess move aimed at challenging the US dollar's long-standing dominance as the world's reserve currency. As the People's Bank of China, PBOC, emerges as the largest buyer of gold globally, and with the creation of the Shanghai Gold Exchange, SGE, and a network of vaults dubbed the Gold Corridor, China is laying the foundation for a parallel financial system. This development has profound implications for global markets, investors, and the future of money itself. Let's dive into the historical context, the mechanics of this strategy, and what it means for the world. Historical context: the dollar's eroding trust. For much of the 20th century, the US dollar reigned supreme as the backbone of global finance, with around 70% of international reserves held in US treasuries, long considered the safest assets on earth. This trust was rooted in the dollar's stability post-World War II, cemented by the Bretton Woods Agreement, which initially tied currencies to gold through the dollar. However, the Nixon shock of 1971 severed this link, ushering in an era of fiat money. While the dollar maintained its reserve status through economic might and geopolitical influence, cracks began to show in 2022 when the U.S. froze $300 billion of Russia's foreign reserves amid geopolitical tensions. This action sent a chilling message to other nations: dollar-denominated assets could be weaponized. Emerging markets, wary of similar vulnerabilities, began diversifying away from U.S. treasuries, accelerating a trend of gold accumulation led by China. Historically, gold has been a store of value during times of uncertainty, from the Roman Empire to the Great Depression. China's strategy harkens back to these eras, seeking to restore trust in currency through tangible backing, a direct challenge to the fiat system that has dominated since 1971. The PBOC's gold purchases, which spiked after U.S. tariff threats under President Trump, are not just a hedge, but a public signal of intent. While official figures peg China's gold reserves at around 200-300 tons, estimates from Bloomberg and J.P. Morgan suggest the true number could be closer to 3,500 to 5,000 tons when including state-controlled holdings. This scale of accumulation is unprecedented in modern history. The mechanics of China's Gold Corridor. At the heart of China's strategy is the Shanghai Gold Exchange, already the world's largest physical gold marketplace, complemented by a new vault in Hong Kong and the Gold Corridor, a network of vaults across BRICS nations: Brazil, Russia, India, China, South Africa. This infrastructure allows countries holding yuan to convert it into physical gold, addressing a key issue: trust. Unlike the dollar, which can be printed or frozen, gold is tangible, difficult to debase, and immune to default. The corridor decentralizes custody, ensuring that nations like India or Brazil don't have to rely solely on China to store their gold, thus mitigating concerns of centralized control. Another critical development is the reclassification of gold as a Basel III Tier 1 asset in July 2023, meaning banks can now recognize 100% of its value on balance sheets, up from a discounted rate under older rules. The next potential step, classifying gold as a high-quality liquid asset, HQLA, would be transformative. HQLA status, currently reserved for assets like U.S. Treasuries, allows use as collateral for loans and repo transactions, the lifeblood of global finance. If achieved, gold could underpin lending and infrastructure development without reliance on the dollar or Western institutions like the IMF. China is also tackling gold's volatility by proposing settlement prices based on a 200-day moving average rather than daily fluctuations, making it a more stable financial instrument. Global and sector-specific impacts. China's gold-backed system could reshape global finance by offering an alternative to the dollar-centric order. For developing nations, particularly in Africa, which produces a significant portion of the world's gold, this presents an opportunity. Through the new development bank, the BRICS Bank, countries could deposit gold into the SGE and borrow yuan for infrastructure projects, bypassing Western financial gatekeepers. This not only boosts China's influence, but also fosters a multipolar financial world where the dollar's monopoly is challenged. For commodity markets, this shift could drive unprecedented demand for gold. Bank of America estimates that new guidelines suggesting central banks increase gold reserves from 20% to 30% of portfolios could trigger $2 trillion in demand. Since gold supply is finite, unlike fiat currency, prices could double within 5 years, impacting everything from mining stocks to jewelry markets. Meanwhile, the US dollar and treasuries face downward pressure as global reserves shift, potentially raising US borrowing costs and influencing interest rates. In the tech and crypto sectors, this could catalyze a parallel narrative. While China leverages physical gold for trust, the US might counter with digital innovation, stablecoins, or even Bitcoin, as a form of trust through technology. Bitcoin, with its borderless, transparent nature, mirrors gold's appeal as a non-debasable asset but offers speed and programmability. If governments begin competing over monetary systems, both gold and digital assets could see rapid repricing over the next decade. Investment and policy implications. For investors, China's gold strategy signals a pivotal moment. Gold and related assets, including mining ETFs and stocks, present a compelling opportunity as demand surges. However, volatility remains a concern until stabilization mechanisms are fully implemented. Diversifying into Bitcoin or other cryptocurrencies could also hedge against a weakening dollar, especially if the US pivots toward digital money as a counter-strategy. Investors should monitor gold prices closely, targeting entry points during dips while maintaining a long-term horizon given the 5 to 10-year timeline for systemic shifts. On the policy front, the US must adapt to retain influence. Repatriating gold reserves, as seen recently, with moves from London back to American soil, suggests preparation for a world where physical custody matters. Policymakers might explore integrating digital assets into the financial system to compete with China's gold-backed yuan, potentially accelerating stablecoin regulation or central bank digital currency (CBDC) development. Meanwhile, international cooperation within BRICS could pressure Western nations to reform institutions like the IMF to remain relevant to developing economies. Near-term catalysts to watch. Several catalysts could accelerate this transformation. First, any official announcement at upcoming BRICS summits regarding gold's HQLA status or expanded use of the yuan in trade would be a game-changer. Second, escalating geopolitical tensions or further weaponization of the dollar could push more nations toward China's system. Third, gold price movements and central bank buying trends, particularly from emerging markets, will serve as leading indicators of adoption. Finally, U.S. policy responses, whether through gold reserve strategies or digital currency initiatives, will signal the West's counterplay. Conclusion: a multipolar monetary future. China's gold-backed currency ambition is more than a financial experiment. It's a bid to rewrite the rules of global money. By rebuilding trust through physical collateral, China challenges the fiat dominance of the dollar, potentially ushering in a multipolar monetary era where nations and individuals choose between gold-backed systems and digital alternatives. For investors, this is a call to diversify across hard assets and emerging technologies. For policymakers, it's a wake-up call to innovate or risk irrelevance. As this chess game unfolds, the next decade could witness a profound redefinition of what money means, split between the ancient allure of gold and the futuristic promise of code. The stakes couldn't be higher, and the world is watching.